Are we live? Looks like it.
I have to change my username and don't ever send me money. Imposters everywhere. Richard Hart, bracket, don't ever send me money. Imposters everywhere, bracket. That's fucked up, right? And I'm out there actually making an effort trying to stop the fucking scams. Everyone else is like, oh, fucking that Richard, yeah, he's a scammer.
Call it a scam, nobody really cares. We can tell you the only one that ain't prepared. Oh yes, I'ma be a millionaire. 5, a couple trillion shares. Oh no, I ain't getting wrecked again. Richard Hart, he got us set to win. We're a family, we all the best of friends. We ain't a cult, man, just call us Mexicans. ICOs, pump and dumps, they always try to take you. Buy low, sell high, I'm tired of your fake news. You need a token, you broken, you wanna see some massive gains? Lambo, new crib, model, wife, cash and chains. Look no further at your final destination. Don't be complacent every day when you paper chasing. Choose the best, leave the rest, stop investing like you press. The only crypto that you'll ever need is HEX. Call it a scam, nobody really cares. We can tell you the only one that ain't prepared. Oh yes, I'ma be a millionaire. 5, a couple trillion shares. Oh no, I ain't getting wrecked again. Richard Hart, he got us set to win. We're a family, we all the best of friends. We ain't a cult, man, just call us Mexicans. Your investments are safe, it's got defenses. A mutable contract that pays trustless interest. I don't understand why everybody is hating. HEX is capped at 3.69 inflation. Shares are like hash rate. The higher you take her, the more daily interest that gets paid to the stakers. Always do your own research, don't listen to me though. It's complete, it can't be changed. HEX is finito. Call it a scam, nobody really cares. We can tell you the only one that ain't prepared. Oh yes, I'ma be a millionaire. 5, a couple trillion shares. Oh no, I ain't getting wrecked again. Richard Hart, he got us set to win. We're a family, we all the best of friends. We ain't a cult, man, just call us Mexicans. The game has changed, ain't no going back now. Dummies that called HEX a scam can back down. I hope you understand, I pray that you follow me. You owe the entire HEX family an apology. And stay sober, cash out, the game's over. HEX is here for the market cap takeover. Buckle up, we about to be full throttle. With multiple auditors where we get paid to hodl. We got the game smothered, sisters and brothers, with no expectation of the work from others. It's complicated, I know that there's a lot to this. For your daily HEX updates, tune to Hexologists.
What's up, guys?
HEX is like nothing that you ever been through. So sit back, relax, and enjoy the pumpamentals. If you like what you hear by now, stake twice. Just remember, yo, this ain't financial advice. Call it a scam, nobody really cares. We can tell you the only one that ain't prepared. Oh yes, I'ma be a millionaire. 5, a couple trillion shares. Oh no, I ain't getting wrecked again. Richard Hart, he got us set to win. We're a family, we all the best of friends. We ain't a cult, man, just call us Mexicans.
What's up, everybody? Welcome back. Dipcatcher Radio. I'm your host. So today we're going to be talking about a topic that's really important. Hopefully this isn't going to be too long of a stream because I know it is Friday night. But what better thing than to talk about HEX? We're just going to be talking about what is the minimum viable stake. Because when people are getting started out in HEX or when they're building their staking ladders, sometimes the interest that they're earning is less than the fees they're paying to do it. And so on this stream, we're going to be talking a little bit about what those different fees are, and then how to think about how those fees impact the ROI that you're achieving from staking your HEX. Because say you're gonna lose $100 in fees in order to earn $80 in interest, then the price you need to be certain that the price is going to go up 25% in that time to make up for that fees. So we're just going to talk a little bit about the just what those different costs are. And I set up this little calculator just before I got on, that maybe over the weekend I might try to add this to the Dipcatcher site. Maybe it'll be one of the supporting tools that we have there. So check, if you haven't checked it out yet, go to dipcatcher.com. This is where I post some tools to help you with your investing. Currently, we mainly cover Bitcoin and HEX. And so maybe one of the tools that I add is like a little calculator for calculating what the minimum viable hex stake is. Because there are a couple things at play with that. So thanks for joining. Got a couple comments here. How's it going, man? Good to see you. Thanks, Zero Carbon Energy on Twitter. New Hexagon 505, my man. It's something that I've been thinking about for a long time because it's pretty relevant. And I've already kind of used just some like rules of thumb around this, but this is definitely really important, especially for new people. Like say you're just buying like $100 of hex to play around with, and you want to test out the staking. Like it can, especially when the markets are booming, that gas fee for the staking and then staking can really eat into it, and it kind of deteriorates the experience. And can turn into a cost. So, to kind of go over what we're really concerned with, let's pull up the hex.vision so we can look at the gas, because the gas has been crazy. We might want to talk about why gas has been so high. So the transaction fees on Ethereum, they're not just for Ethereum transactions and for token transactions. They're for every smart contract interaction. So in Hex, like when you stake your Hex, it does a transaction where it sends your hex to the burner address, so that costs a little bit of gas. It updates the share, like the accounting of your shares. That's a little bit of gas, and then so like that's like what you pay. But then when you end a stake, you pay a little bit of gas to send the transaction from, like to mint the hex into existence. That costs some gas. To calculate how much interest you earn over the duration of your stake, that costs some gas. And so, things other than just the sending of money can really eat up the finite block space on the Ethereum blockchain. And that can cause the price to go up. So what you can notice is that when we look at the gas prices on the hex.vision site, so it spikes. So this, like, because sometimes there will be a smart contract that's burning through a lot of the gas, and then it kind of slows down a little bit. And sometimes smart contracts they only need to do updates whenever complicated things are happening. So one example of things that can drive the gas prices up is if like there's like and it's why we see it on days when there are massive price swings, when there's a lot of volatility in the market. One, there's a lot of trading, trading on the dexes, that takes up a lot of the block space, and that really drives the price of gas up. So the trading, I think on Etherscan, right here. So Uniswap, so trading, that just takes up a lot. So when there's a lot of volatility, there's a lot of trading. When there's a lot of trading, there's a lot of gas. So that's like one of the main drivers. Just Tether operating, like if Tether was to move to layer 2, that would free up some, not a lot, 7% of the gas used in the last 3 hours, 10% over the last day. So if you look here, like, most of these are exchanges, 1inch exchange, Sushi Swap, that's an exchange, tokens too. But what is interesting is that it's not only just the exchanges, it's also lending pool. Like anywhere that a contract needs to open up, or anytime a contract needs to update a value, like say from a price oracle, it needs to consume some gas. So like all different, like when the prices run, there's a lot of trading. The smart contracts and these like blockchain protocols need to update their oracle price. So there's activity on some of these other ones. Sometimes when especially with like a lot of this kind of more exotic things going on in DeFi, like some of these different like lending pools, like all these like kind of wonky financial products that I think are kind of outside of the scope of what people, just like the regular investor, like that's a very particular type of activity going on. Like when they're launching these like liquidity pools and these like liquidity mining protocols, that can cost like hundreds of dollars in ETH gas. So there's like a lot, like the things that drive the gas prices up are things far beyond just the simple transactions. Like in Bitcoin, the prices just go up when people are transacting them because they don't really have, there's no smart contracts on Bitcoin. So the Bitcoin fees will go up because the block size is so small and they're so infrequent. But since Ethereum has a much faster block cycle and I think larger blocks, someone have to check that for me, but there's just so much more that can be done. And so when that block space really clogs up, like you can definitely see it in the price. And sometimes, we'll see gas like reach like 500 gwei. So let's see how many gwei per ETH. Let's see. So 10 to the 9. So 1 billion gwei. So if we did 5 times 10 to the minus 9 times 10 to the minus 9. Let's just see or 500 gwei. So like on these peaks, and then say the price of Ethereum I think is like 1,200. So on these peaks, like per gas unit is 0.06 cents. And so depending on how much actual gas is required on these days, like that can be a massive amount. Like sometimes when you look at your hex staking tools and you see like the cost to enter a stake is like $30, or like the cost to end a stake is like $100, or even like remember when the uni airdrop happened and there were so many people trying to free claim their uni and you had to sign a transaction in order to do it. The gas fees were so high because so many people were trying to do that transaction. All types of things can really drive the price. And during that time, everything else was more expensive. And so overall, like, you wanted this site that the guys that built Hex Vision stood up, it's so helpful here because it shows you what times of day and what days have generally lower gas prices. So overall, like Monday, like just from like over the last 30 days, Mondays are the most expensive days to perform a transaction. Like where the average slow gas price is 103, whereas on Sundays the average has been 62 gwei. And so I guess like first piece of advice, if you're doing anything on like at a small scale on Ethereum, just wait till the weekend because there's like a pretty big difference in the gas fees from weekend to busiest days of the weekdays. And if it's on a day where like prices are just going crazy, just keep that in mind. Like you got to really want it because like, excuse me. Oh, excuse me. Like you got to really want it because you just got to like at least with like the fee that you pay to swap ETH for Hex, you kind of just got to factor that into the price. So like, say you put $100 of Hex or $100 of ETH into Hex, and then with like the Uniswap fee to do that, say it was like really busy day. And like that's the thing about the gas fees is that they don't care how big your transaction is. Like from the gas's perspective, every transaction in terms of size is roughly equal. There may be some nuance to like exactly that, but how accurate that is. But you pay the same fee for a small transaction versus a large transaction. And so if you're doing say you do $100 purchase, and on that day, just the Uniswap fees are just super high because of like, there's just a lot of activity on the network that day. And you end up paying, say, $20 of Ethereum of gas, then that means that, you actually got, your $100 of Hex actually costs you $120. And so the effective, like, and say you're looking at the chart, Hex is a penny, say the day you bought it, but then you buy it, but you paid $120 for that $100 of Hex. And so it's like the same, it's like as if you were buying at like a 20% higher price. So for like the transaction fee that you pay, just to on-ramp into it, that is, you kind of just need to like consider that, baked into the price you paid. And so, on the chart, it might look like you like sniped a dip, but in reality, like considering the fee that it took to get the Hex, your actual price paid could end up being a little bit higher than what you might be seeing on the chart. And so, that kind of, covers it on the gas. And so the other type of fee that you'll pay is just like the on-ramp fee. And so, this is just depending on how you get your money into crypto. So for instance, I think that the best zero fee way to do this is to put, is to use Coinbase, but you have to wait for your money to deposit. So like you can usually, like on Coinbase and other services, you can usually withdraw your crypto immediately, but you typically have to pay a pretty high price, like 1%. Or more. I'd have to check. So like say, like you have, let's do an example here. I made this calculator to kind of work through some of these things. So say you had $1,000, and the ETH price, just for ease of conversion here, say the ETH price is like $1,000. So like in order to get your ETH, say you wanted it immediately and you paid a 1% fee to do it, then you would get, you would actually get $9,900 of ETH. And so, but say you can wait for a week for your money to deposit, then you get the full amount. And so now so you got $1,000 worth of ETH, but say during this time, you chose to get a 0% fee by waiting 5 days in order to move your funds. But say during that 5 days, the price of Hex goes up a lot. So like, you have to just factor yourself, how bad do you want it and how much of a fee are you willing to tolerate? Because, sometimes you may benefit more by, getting your funds immediately, paying a 1% fee here, just so you can buy your Hex at a price that, might be lower than what it is in 5 days when your funds become unlocked. So there's really no way to tell what it's going to do. And so, it's just like a decision you have to make just based on your own situation with like what services you use to on-ramp into crypto. But say for this example, let's just say that you were able to wait for a week in order to get your crypto. And so you got $1,000 worth of ETH, and then you send it to your MetaMask, because you're going to turn it into Hex. So just, we'd have to look at what the transaction fee is right now. I'm going to do a little example in my window that you guys can't see. So like right now, the ETH transactions are like, just for sending ETH is like $1.50 for the average. Slow is $1. So say, you can tolerate, waiting a couple of minutes. So, $1 transaction fee to MetaMask. And so what you end up with is, $9,999 of ETH. And so say the Hex price is a penny. But then today when I looked at actually, no, I didn't look at that price. So say you're on the site to swap for, some ETH. Let's look up what the gas prices are for just a Hex swap on ETH. Let's take a look. We can fill this in this calculator. So for a Uniswap right now, the gas fee is $10.58. So like, let's just put that in here. 10.58 of ETH. And so rather than getting $9,999 of HEX, you're actually getting, so it's B7 minus B9. Let's put that in parentheses. So you're actually getting 9,998 or 998,000 HEX. So like, considering the fees of your on-ramp fee. So here, let's actually do it. Say you wanted your funds immediately. So for your $1,000 that you started with, you actually, on a day when the price is 0.01% or $0.01, so price is a penny, you put in $1,000, costs you 1% to get it into crypto, and then you paid $11.58 in gas fees. The price that you actually paid was something closer to, let's see. So we want to look at dollars per hex. So $1,000 divided by, so the price you paid was actually a little bit higher. It was about 0.0101. So, which is expected because you pay a 1% fee there, and then that comes out to like 0.1% of the total. So, like that's bearable. That's not too big of a difference. That's within, these fees are usually acceptable because the daily volatility is such that 1% that you're paying there, like, price could just as easily be down 1% that day. So like, if the fee is based on a percentage of the whole, that's usually all right, because like if you're paying a little bit, it's a little fee. If you're paying a lot, it's a big fee, but it's against like a larger amount. And so usually the on-ramp fees, which are like a fixed percent fee, those are typically all right, to just eat. But the ones that really can throttle, like the gas, that makes a big difference, because say rather than starting with $10,000, you're starting with $100. You're now paying, 0.011. So you're actually paying like 14% higher, because this gas fee doesn't care how big the transaction is. And so, the smaller amount that you're buying, the larger impact this gas fee has on you. So for small stakes, like say you're putting $100 in, like you're usually gonna, like, at least with how fees are, like literally right this moment, you could be paying up to 10% or more in fees. So, waiting for the timing to be right so that you can get a low gas price, and then also just like, increasing just like the amount you're putting in, that can really help make a difference. But that's just kind of how you have to think about it. Like the fee in order to get the thing that you want, you can just think about it as however much you got, or however much you put in divided by however much you got. And that's just like the price you got. It's not going to be the same price that you saw on the chart, because the chart doesn't factor in the fees. But, just look on the chart, and if you're also satisfied with like say you had bought it when it was just like a little bit higher on the price chart, that's effectively what you're doing. And so you just got to be happy with that. So that's why, like buying at the top, when prices are reaching all-time highs, fees are usually high, because like they're only reaching all-time highs because so many people are buying. And so on days when prices are just pumping, fees are high, and the price is high. And so like so like people who are buying with high fees during the high time of price, they're like paying even above the top of the chart. And so, you just got to keep that in mind and just kind of like characterize it to yourself that like, that's just like the cost of buying it. So just factor that into the price. Because, there's really no way around it other than, some of those things that I just said. And so then the next part of it, there's a little bit more to it. So when you're staking the hex, starting a stake is pretty cheap. Like right now, I just tested. It was like $3 to start a stake. It's so funny. Back in I think like January or February, whenever ETH was really low and whenever hex was also really low because no one knew about it, you could stake for a penny. So the gas for starting a hex stake has gone up dramatically. Just because all Ethereum fees have gone up by that same scale. But like today to start a stake is like $3, and when I recently ended a stake, it was something like $10. So these will vary. It's kind of hard to predict these. So say we're just gonna leave that. And then like when you choose the date, this will be important when we kind of get to the end. So let me explain exactly how this calculator works, and we'll start toggling some of these numbers. So you pay your gas to start, and then the gas to end is higher because there's more operations to end a stake because it needs to calculate the interest. And I think that's also when it updates the share price. So the end stake definitely eats up more gas, and so it just costs more. And then so what you get in exchange for locking your hex is you get the T shares, and the T shares are the source of the yield generated by the hex smart contract. So hex inflates at a constant 3.69% per year, and that is distributed to all the stakers based on how many T shares they have. And the amount of T shares per hex, so the amount of hex per T share is always going up because that's how the compound interest is enforced. And that's what ensures that a single 15-year stake will always earn more than 15 one-year stakes. It's just what enforces longer pays better and makes the interest compounding. And so, the amount of shares that you get is, will always go down. It's deflationary. It's one of the most deflationary assets in crypto. And it's what earns you interest. And so like say this so for $100 you got 8,742 hex, and you staked for 30 days. So the total fee you paid for that was $13, like for the staking. And you got, at today's share rate of $16,600, you got half a T share. So this is like another one to estimate, like what's the price at the end of your stake. So say the stake started and then in 30 days price is at 1.2 pennies. It's gone up 20%. For each of those 30 days, you're earning, where do we have this? Let's go to graphhex.rocks. Okay. So this is what shows the share rate, always ratcheted up in a big way after a big payday. And so today the daily payout per T share was 5.7709 hex. So each one of these T shares was earning this much per day. And so the total earnings is how many days times how many T shares times the earnings per T share. So this 30-day stake earned 90.7 hex. And so the total hex is, 8,832 hex. And so the total value of the hex is 105.99. So even though like the price from when they bought it to when they started went up 20%. The actual return on investment that they got was actually, about 6%, because, because with this, they, like considering the fees just ate into the interest earned, and the price increasing. So, so like the value of these earnings for this 30-day stake was $1.09. And that wasn't even enough to cover the gas to enter the stake. So the amount they earned, so only factoring in the gas, not factoring in the on-ramp fee. So, only factoring in the gas, they, their earnings was only 8% of the fee they paid to earn that. So it's like you just gave away money to the ETH miners. So let's see what, and so like your total fees is 25. So like just like considering all the fees, you paid $25 and you only earned $1.09. And so you actually lost $24.49 from, just like all of these fees. And so that's pretty high. And, so like for these short-term stakes, so if you have friends that are just getting started in HEX, really emphasize it. Not only does longer pay better because it earns you, more, more HEX, like more shares per HEX. But it also decreases the burden of the fees per day that you're bearing the opportunity cost of being locked. Because like during the stake, price could go up like a flash pump to $10,000, and the people that are staked can't sell into that. And so like you're bearing this opportunity cost and you're bearing the cost of the fees. And so if you can just, spread out that cost of the fees over a longer period of time, it's just like less, it less aggressively eats into your ROI, because, with like longer pays better, you can counteract the fees by earning more HEX per HEX locked. And so that's really the part of the power of longer pays better is it helps counteract these fees. So say like this person, even did like a 300-day stake, you can see that like the gas adjusted, or, and that's considering that the price only went up 20%. So let's just say like, we don't even need to throttle that, so like with even a 300-day stake, putting $100 into HEX is still at today's gas prices is still a loss. Like if price goes up to 120. So in order to break even, like you would need the price to go up. Let's say like it goes up in that time 50%. So even 50% over a 300-day stake doesn't put you where you need to be to cut even. Not even 100% gain. We could get back to our all-time high, which this is part of the HEX conspiracy theory I'm going to talk about at the end of the video. So stay tuned. At the end of this, we're gonna talk about a conspiracy theory that only I know at this point. So stick around. But say price gets back to our 2 penny New Year's Eve mark, 100% gain. That $100 HEX is still losing. And so let's see if we would have put so like with small amounts, like even right there, like, so let's bring this back to 20%. Even just staking more just like cuts right into that, because this bit like the big cost factor right here is the these the fees that don't care what the price is. Because like if you have $100 of hex, like these fixed fees, not these ones that are percent of the whole, like these fixed gas fees, they represent a larger percent of what you had to start. Whereas like if you do have $1,000, like immediately you break even. So even if price didn't, even if price didn't move, if price stayed static for 300 days, you still made money. And so if you only did 30 days though, you lost money. These are just kind of like the different levers involved. How much you put in and how long you staked, and what gas price you got. So just kind of, quickly illustrating there that more money, these fixed fees are going to have less impact on your ROI. And then two, just per dollar you put in, there is a minimum viable stake. Like right here for like $1,000 put in at current gas prices, considering, considering that like today's payout per T-share, let's try to find what the minimum is. So $40 stake, you're still losing 500. You're making, I typed in too many zeros. So you're still losing 17. Let's try 100. Yeah, so right around 100, that kind of works out nicely. So right around the $100 day mark for a $1,000 stake, considering these fees, that's about your minimum viable stake, because the amount that you earned is just slightly less than, let's say, 101 days. 102. Oh, 103. I bet that'll be it. Yeah, so like at 103 days for $1,000 put in, you're earning just over what you paid in fees to start the stake. That's if the price doesn't move. So again, this is a big driver because this is what multiplies at the end. When you're staking this out, you don't want to be close to this, because say price moves against you, like say this is minus 20%, then you still didn't make, because those fees don't care what is going to happen to the price, and you're earning more hex, but it's going down in value. You could price moving against you can even further amplify that loss. Especially with a short-term stake, for say you did a 30-day stake here. It can really eat into your losses. So for $1,000 stake for at least 100 days, and considering and hope that the price at least stays stable to where you started. That's pretty important. Let's see if there's anything in the chat. New Hexian 5 says my first few short time frame stakes were way too small. Yeah, that's it was impossible to predict. You would have had to accurately predict the gas fee at the time, and during those days the fees were really cheap to enter a stake, and so we figured they'd be the same to exit. But as we've seen, when that gas price goes up, the unstaked price goes up. Which actually makes it it's positive for the price, because it limits how many liquid hex can come back online. Because if there's a lot of little guys who, little guys are always the most likely to sell. If you have all the little guys that are now can't end their stake, it either bleeds out and gets paid to all the stakers, or it, they just, or someone runs good accounting on them, like as a prank, and then it gets paid out, it just bleeds out and gets paid to all HEX holders, not just the stakers, by, effectively just being, if they can't afford the end stake to remint their HEX, that HEX can't be sold. And so, those guys, with the short-term stakes, that adds deflationary pressure on the HEX. And so I think that'll really, especially like a lot of people that were building these like super fine HEX ladders. I think, ones where like every week for 15 years, they're going to have HEX coming back online. I think those people are not going to be so profitable because, what these show right here, like these fixed fees, these fixed gas fees that don't care about how big the transaction is, that can really eat into your earnings. And if you're having to pay that fee every week for 15 years, you better hope that the prices are pumping and the APY is high, because a lot of those short-term stakes, you could be paying thousands of dollars in penalties, or not penalties, in fees. So that's a really important point. JJ says, "Have you tried WETH?" East? I thought you said West. Yeah, so I didn't. So that's a good point. For that Uniswap or like the Uniswap transaction from ETH to HEX, if you preload a bunch of ETH into WETH, ETH? I thought you said WETH. If you preload a lot of ETH into WETH, in order to prepare it to be executed with smart contracts, you can save money like on that per fee basis because it doesn't have to do that step for you. And so you can typically swap ETH to WETH with no fee, and that will enable you to do Uniswap a little bit cheaper every time. So it helps. Like I think Richard was tweeting about that, like preloading your ETH into WETH, and then the way you can even further reduce your cost is to set limit orders on 1 inch. So here, let's how to reduce fees. These are good topics. Reduce fees. So this will be a whole. So for every row here in this fee calculator, we'll talk about how you can. So reduce your on-ramp fee. So wait 5 days or 4 days for Coinbase deposit. So that'll take that to 0. So that's like one way to do to reduce your fee. Transaction fee from Coinbase to your MetaMask. I think sometimes they cover it for you. I'm not sure, but wait for slow ETH day, weekend. So check the gas charts on Hex.vision. Slow ETH day. So this one for swapping your ETH to HEX. So preload, so pre-convert your ETH into WETH, and you can place limit orders with WETH on 1inch.exchange. So placing limit orders, it's pretty much placing a below the market value order, where if the price comes down and hits your order, it'll get filled. But if not, it'll just go away. And so the makers pay the takers in this case. And so if you place a limit order, that means you're a taker and you're not paying the transaction fee. So, but the risk with that is that price just may never come back and hit your level. So like, let's pull it up right here. Let's look at this chart. What a beautiful chart. Like, who's seen anything like this? So here, let's zoom in a little bit to the 6 hour. So like, say you're on 1 inch, you've just converted your WETH into ETH. You set a limit order for, okay, we'll zoom back. So say like, it's priced over here and you're like, okay, I'm going to set my limit order for 0.00755. So let's do so you just go long here. So ignore these, like take profit and stop loss, whatever. But like, say you place your limit order right here at like 0.77 pennies. And then price never hit it. Like throughout all this time, like price almost hit it. And then say like, price just, carried on into the uptrend. Now, rather than, like your order never got filled. So you were there like penny pinching on your fees, but then price never filled your order. Now price has gone up 100%, and that 100% loss you had to not having your order filled is way larger than the amount you would have lost to fees had you just market bought on this day when price was a penny. So there are risks involved in 1 inch. Like, you have to be certain that the price is going to hit your order. So if you're placing limit orders, maybe a better way to do it would be to just zoom in on the chart and just place your limit orders slightly below the price. This way you have a higher likelihood that they actually get hit. And so you don't risk the price running away from you. And then, but you'll still be filled as a taker, and so you won't pay any of that fee. So that's like how you can reduce the fee, is doing limit orders. But keep in mind the risks of limit orders. Price could run away from you. So that's scary thought. Another way to reduce the impact of the fee is to spread it over, increase the length of your stake. So that way, these fees, if you think about the cost of the fee as, break it out over the length of your stake term. So if you have like $20 of fees over a 5-day stake, that's like $4 per day. That's like every day you're waking up and pulling out $4 of your pocket to put on your stakes. And that kind of sucks. But say you bear that $20 of fees over 100 days. And so, in that case, what is that? That's like a quarter a day. So 25 cents per day. Maybe my math's not right. But, so it just enables that fee to be less of a driver over the time period of your position. So just increasing the length, other than getting you more shares, meaning more earnings per day, you can if with the longer pays better bonus. So longer pays better means more shares per hex, which means more earning per hex. You can increase your up to 3x. So if you stake at least 10 years, you're earning 3 times more shares than you would have for staking for 1 day. And so just staking longer, it not only spreads out your fees over more days, it will amplify your earnings during that time period. And so that's another solution for reducing the fees. So what other fees, and how else could we reduce this? Let's see. I guess also like, placing limit orders, if you're placing them below market value, waiting for price to like wick down and fill your order, that's like another way to kind of eat into that fee. Like if you paid 1% to buy your ETH, but then you got your order filled at like 1% lower price than like what it was, say over like some volume weighted average price, then that kind of makes up for it. And so like, placing a limit order also has the effect of doing the, it also has, like it can help counteract the fees just by getting you a better price. So yeah, that's what, this is kind of, hopefully over the next couple days or weeks, I'll publish this calculator. Maybe I'll just share one in the chats or something that you could just like, kind of play with. Ideally like something that I would, maybe someone out there watching knows this. If you do know the answer to this, leave in the comments here. How we can calculate the gas consumption of a hex stake. Like how much, like per length of stake. So, because this is just an estimate, and I think that the longer the stake, the more gas, because it has to calculate over more days. I'm not entirely sure, so that would be really helpful to be able to get an understanding, or if someone could point me into how to understand the gas, the gas consumed per day staked. Hopefully, we'll continue to develop on this idea, but overall, this is like really important. Just like rule of thumb, if you have $1,000 of hex, if you're buying $1,000 of hex today, you should at least stake for 103 days, because if price was to remain constant throughout that time period, you want to be, you will just about break even. And so just like rule of thumb, 1,000-day stake at today's rough gas prices, which are, when we looked at, what does it say it is right now? 42 Gwei. At these current prices, $1,000 in stake for at least 100 days, but ideally stake for, say, 5,555 days. And yeah, so that was all I had on that topic. So here's the other thing that I wanted to share with everybody. It's actually, I think, a conspiracy theory against hex. I think there's coordinated effort to try to suppress the recorded gains that the hexagons will have over 2021. And here's why. So who remembers the crazy price pump on New Year's Day? So going into New Year's, right at 0 UTC. If you remember I wish I could find it. I'll have to find it maybe on Twitter. There was some type of like smart contract. So like when you looked at it on Staker app or Hex.live, you know how they say if it's a bot, meaning it's a contract? There was a massive buy and sell order just a couple moments later, where for over right over New Year's, let's zoom into the hourly chart and let's see if we can go back that far. Like right leading up to New Year's, someone pushed the price up to just over 2 cents right there on New Year's, and then sold right back down. And they did it right at New Year's. So right there, as the day ticked over from 23 to 0, 2020 to 2021, someone pumped the price to 2 pennies and then immediately sold. So considering the fee that you pay on Uniswap, the fee paid to the liquidity pool, the price went, like they probably pay, and this was like a couple $100,000 order. This person paid like a pretty big amount of money to pump the price up, to paint the chart so that it looked like the price at the start of the new period was closer to 2 cents. And here's why I think they did that. Because when you go to the monthly chart, and also if you go to the yearly chart, now when people are comparing the gains of assets for the year 2021, somebody pumped the price from where it was, which was about like 1.3 cents that day. They pumped it to 2 cents. And I think they did that so that, like, for if you were to look at the yearly candle chart, now the start of year is 2, when in reality it was like 1.3. And so now when people are measuring 2021 performance, they're not starting at what the price actually was at the turn of the year, which was 1.3 cents. They're starting it a little bit higher. And it may seem like a small difference, but when we're calculating how many percent or how many X price runs in 2021, now, because we're starting at a higher starting point, it takes more money and more percent increase in order to tack on each additional X in price by almost a factor of 2. So say we're measuring, so say in starting at where price was when they pumped the price to like 2 cents. So say in 2021, HEX goes to $2. Okay, so right about there. So say in 2021 to 2022, HEX goes to $2, 10,000% move. Measuring that from the $2, like the start of the candlestick, that's what it'll take. But say price had actually been measured from where it was before at 1.3, that same move is 15,000%. And so somebody out there, I think, painted the chart and bore significant cost so that when HEX outperforms every market in crypto and in the real world in 2021, the number of X's that we gain will be suppressed because it started from a higher price. So that's my conspiracy theory. I think somebody's trying to make it look like HEX doesn't perform as well in 2021 by making that starting point higher. And so the thing that, the trade-off to that was that they made the 2020 performance even crazier. Because if, now looking at the, like our performance from very bottom, January of 2020 to start of January of 2021, that's 26,000% compared to where the price was that day at like 0.13, compared to like 20%, 20,000%. So they sacrificed making our 2020 performance amplified, but they did that in order to make it so that maybe something else has a chance of being the highest appreciating asset of 2021 because they pushed us up to a higher starting point. And when you measure that percent gain, the lower that you start, the less additional pennies required in order to add another X to your ROI. So who knows? Maybe someone can do some digging on that. Someone on Twitter, we'll have to find it and share it later. Someone found that transaction, and it looked like it was some type of like arbitrage bot. But who knows what types of funny business that someone was doing to try to limit what the 2021 ROI performance is. But doesn't really have that much of an impact. You know, the other effect that having that kind of like bastard wick on the chart has is that it, you know, it's good and bad. On the positive side, it makes this dip look a lot juicier. So people that are like, you know, just looking at it right now, they're like, oh wow, we're in a 60% dip right now, because, you know, that last that was the high, it was at 2. But then when you look at how many people actually bought and sold there, not enough people bought or sold at these highs for the market to have much memory of that price. And that's like why these levels, you know, that's why the levels, you know, matter, like where price trades a lot, because those levels represent like where the market remembers that price was. And if almost nobody was trading on this day, then the market is really not going to have much memory of that. So, you know, I guess it is kind of positive for the price because it looks like a bigger dip. And now instead, like once HEX breaks this 150, that I would say is like the true high. Like this 2-cent high, like it's kind of a bastard measure. You know, someone was doing some funny business. We don't know who, and they bore the cost. So like, you know, feel like that. You know, it's not really funny business because, you know, they paid to do it. It's a valid transaction, valid swap. So, you know, they're totally in their rights to do that. You know, there's nothing funny about that at all, even though it is some funny business. But really the highs that we need to get to before we enter like another wave of price discovery is, 150, 1.5 pennies. And so, you know, in reality, you know, like on the chart, we're in a 60% dip, but really we're in a 37% dip. And in order to regain the previous highs, we just need to go back up, you know, like retracing that 37% dip is like a 63% gain. And so wherever price finds a bottom here, you know, hopefully from, you know, new buyers are entering the market. Wherever this bottom forms, once we go, like, so say price kind of like, you know, finds a bottom at like 80, you know, you don't know what it's going to be, you know, but say, you know, it starts to recover, maybe regains that high, you know, fights this range, and then, you know, is on its way. Like now, like this is really the resistance level. Like I wouldn't consider this previous all-time high, I wouldn't consider that very strong resistance because like no one was trading there. It's just like a bastard wick on the chart. And so like once we break through this 150 level, I think that's when we really enter some like, you know, face melting price discovery. And so, you know, those are just kind of, you know, my thoughts on what this wick means and what effect it's going to have going into the future. Let's take a look at the chat. Someone said, have you tried WETH? No, I haven't tried. Well, I actually have, but not for the sake of saving fees. But I'll have to try that. I don't think the HEX contract has nothing to do with WETH. So I don't think it saves you the money on the staking and end staking. But for sure that, you know, like on 1 inch, you can definitely see the difference it makes. Ryan Hex says sup. I think was Ryan Hex the one that used to publish the staking ladders? I'd like to hear his thoughts on some of those more aggressive staking ladders. I think by now, just, you know, I mean, but you know, yet again, like when people like early on in HEX, no one had such as good of a grasp on what the true cost of staking was going to be and what the dynamics would be. And so, you know, there's no way to tell. And that's kind of, you know, like, that's just like part of the evolution of these things is that, you know, there's got to be a crop of people to come in and do something that ends up not being the right choice, because then you can look back at that and everyone else can be like, okay, that didn't work because, you know, if you have too many stakes, you're going to just be paying a lot of these fixed fees and it's just going to eat into your ROI. You know, rather than having that money have been staked, you should have kept it liquid because maybe there, you know, during this time there was a 500% pump that you could have sold into and you would have made more than staking during that time. And so, I think that like, that crop of people that had the like really high frequency stakes, I don't think we're going to see so much of that anymore. I think that over time, what it will converge to is less frequent and longer stakes, and also, people maybe keeping more hex liquid, because by keeping your hex liquid, and this is something that I think we even have a chart here on the hex.cash site. When you keep your hex liquid, the only cost you're paying is the inflation that you are paying to stakers. And so with this chart here that we have on the hex.cash site, let's pull it up. What this chart shows is how many T-shares are required to out-earn the hex supply inflation. So like this bottom is how much hex you have, and this of liquid hex, and how much how much hex you have total, liquid and staked, and how many T-shares that you need in order to keep up with inflation. And so let's zoom into this smaller amount. So if you have, say, 5 million hex, you're going to be paying 3.69% inflation to the stakers unless you have 86 shares. Because at 86 shares on 5 million hex, you're going to be, you're keeping up with inflation. Inflation's increasing at 3.69%, and you are earning 3.69% of the daily payouts over that time. Your amount is increasing at 3.69%. I think so. To be clear, and so say you end up with you have 5 million hex. So let's see what that. So say that's like $50,000. So that says right there that you need about 84 T-shares to break even. So let's see how to get to 84. So on a max link stake, you get 300 T-shares. So let's see what 2,500 puts us at, like probably 150 T-shares. Why isn't that updating? Oh, that's why. Okay, so this calculator doesn't factor in longer pays better, so we can forget that. But so like you need at least that amount to break even on the staking, or on the inflation that's being paid. So like that's the only cost of holding liquid, and that cost could end up being less than what you're paying in fees. And so these are all the things that you just have to consider. There's no certainty around this stuff, because all these change. But overall, like the best strategy, again, like this just kind of reinforces that longer always pays better, because you can spread out that cost over a longer period of time, and you're earning more hex throughout that period. And so, these are all the things you just have to think about when you're trying to strategize just how long you're going to stake, because it all makes a difference. Let's see if we had any other things in the chat before I get off. Oh, what's up, Daniel? QC Organic said 3 days in the weekly chart looked really good at the time. Let's take a look. So at that time, let's look at the weekly chart. Oh yeah, I mean the weekly chart still looks good. Like, are you kidding me? This looks like the classic, like when you look at the Hex weekly chart, it literally looks like a classic Bitcoin bull cycle push exhaustion. Like you see it on every time frame. Like even let's just look at the weekly chart on Bitcoin during the last bull market. Like, here, let's go to the log chart. Let's get rid of these Bollinger Bands to the log. Yeah. Like that shape that we had on our chart, like that big, like, you know, push, exhaustion, boom, like that thing that we see there, it literally looks so much like what we saw like right here. Like literally, this looks exactly like Bitcoin breaking out of the $400 lows. Like, you know, it's similar type of price action, you know. And if you get rid of that bastard wick, like it's still like, you know, just treat this next one like the top. Like that still looks like such like a healthy, you know, push, exhaustion, you know, we'll wait for some accumulation and then some continuation. So, you know, it's hard to be bearish on HEX. The only thing bearish about it is that literally nothing. Like the only thing bearish about HEX is that it's performed so well that there are lots of people with you know, profit to take. That's like the only thing bearish, but like that's not even so bearish because the price goes down and you just buy more. Like for things that you want to always be accumulating more of, like you're actually hoping for bearishness. And if the only bearish thing about it is that there are people with massive profits that can sell, like that's a good thing. Because once they run out of profit to sell, then you know, they can't push the price down anymore. Diane asks, when is it useful to use the good accounting feature to end a stake early? So good accounting isn't to end the stake early. Good accounting only it only ends your stake, but it doesn't mint your interest. And so that and it's a function that can be run by anybody. You don't have to be logged into your account to run it. Another account can run it for you, but they can't run it until your stake has ended. And so it's useful, like say you're in prison and you have HEX stakes ending. Somebody knows your address, but they don't know your private key. They can't unlock your wallet. They could end your stake so that you don't get the late end stake penalties. So after your stake ends, for 100 weeks, you lose 1% per week, because if you have, it's a way to make sure that like the way that it's a way to make sure that the accounting mechanism that doles out the interest payments is always accurate. Like it needs the ended stakes to end. And so good accounting lets you end the stake, but doesn't let you earn the, like doesn't mint the interest. And so good accounting is useful in that case if like you don't have access to your wallet, or if you have your private keys stored in a really secure way that like makes it difficult to just like regularly access. You might want to run good accounting just so that you don't have to like, you know, go into, you know, you don't have to like travel to see your, you know, like the lawyer that has a fragment of your phrase so that you can unlock your wallet. It's like a way for you to end it without having to log into your wallet. So that's one reason to use it. Another reason to use it would be in some jurisdictions there's like tax consequence to like just based on what year you get that income. So if it's classified as income in wherever you live, you might want to run good accounting to like push it off into like a later tax year, if that makes sense for you. So there are a couple of reasons why you might use it. But overall for like the average user, it's better not to use it, especially for small amounts, because good accounting still costs gas, and then ending the stakes still costs gas. So you end up paying more in transaction fees if you run good accounting and then you also run the end stake, because end stake is what mints your interest. So running both doesn't usually make sense. It's better, like in most cases, just to end the stake. Unless like for your special circumstance, you really need, you either don't have access to that wallet easily, or you know, need to defer, like based on your jurisdiction, need to defer that income to like a later time, but you don't want to experience the late end stake penalty. So there are a couple reasons to use it, but for most people, it's generally not useful. It's better just to end the stake early. Or no, not end the stake early, just end the stake on time. You also don't want to end the stake early because you will pay penalty depending on how long you ended it before your stake ended. But good question. Yeah, so I think that's. Oh yes, yeah. Thanks for joining. Yeah, so unless anyone in the chat has any more questions, I think we might be signing off here. It's about 8 o'clock. Yeah, so thank you everyone for joining. Really great time today. Thanks for all the good questions, and hopefully this was useful. Just whenever I get around to it, I'll try to publish this so that so other people can use it. Maybe put it on like a Google Sheet or something. Maybe might build it into the website. Who knows? But this is a lot of fun. Thanks for sticking with us. And hit the like, hit subscribe. Share across. To everywhere that you're on. And yeah. So until next time, we'll see y'all later. Thanks for joining.